You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Well, hello everybody. Welcome back to the podcast. I thought we would go one more time on the topic of long-term care, and just so that you can have a more full understanding of what it is and what your options are. Now, certainly there is a lot more depth that I could get into. There's a lot more different details and features and things regarding each of these different types of long-term care, but I just wanted to give you a very general overview so you are aware that this option is out there and what the different types are. And so the last week I went over more of a pure, I would say, style of long-term care, which is just like renting coverage, like car insurance or health insurance, something you are paying for as you go. And if you don't need it, you're not going to receive any money back for it. Just like your car insurance or your health insurance, if you end up not using it, they're not going to refund you any money. If you pass away, they're not going to pay a lump sum to anybody. The same with long-term care, more of just the strictly for only long-term care version and type of coverage. There is a policy for that where you're just basically paying for it as you go your whole life until you pass away. Or until if something happens, you can't afford it, but hopefully you are able to maintain that payment your whole life, because the nearer you get to your end, your last days, the more likely you are to need this coverage. So the type that I explained last time was that sort of type where you're more like renting the coverage. And so I thought I would share some basic features of that type of coverage, and this also crosses over to other types as well. So one of the obvious, more basic features that comes along with a long-term care policy is the benefit amount. How much are you going to actually receive if you need to claim this benefit? So you have different options on how to receive this benefit. Different companies do it differently. So some companies might offer it as a daily benefit, say $100 a day, $150 a day. The highest I've seen is $300 a day. That is your starting amount. Or a monthly benefit where you're just saying, oh, I'll receive $3,000 a month if I need it for a long-term care need, $5,000 and up to $10,000. $10,000 is the highest that I've seen for just a pure long-term care policy. So you would select the benefit amount that you want to pay for. Of course, this will directly affect the cost of your premium, how much benefit that they would cover for you. And if you don't choose an inflation rider, which I will get into in just a minute, then that would be just the flat payment you would receive. If you want a benefit of $5,000 and you do not have an inflation rider, then you would receive $5,000 in the event of a long-term care need. And that would be $5,000 a month when I'm saying $5,000. The other thing that you would need to select is a benefit period. How long would you want this benefit to pay out if you were to have a long-term care need and trigger your benefits? I've seen benefit periods from 2 years, 3 years, up to 6 years. Some companies max out at 5 years. Also, I have seen one of this true long-term care style policies that would allow lifetime benefits, which is something that has gone away with a lot of companies. And not a lot of companies do lifetime benefits. And actually, there were a lot of companies that were offering lifetime benefits. I know a lot of people who actually had lifetime benefits with their long-term care policies who use them and who use them for a long time. We had a neighbor who was on long-term care for over 20 years. And so because of this, actually, the companies hadn't realized just how large of a need there was out there and how long people were staying on this coverage, and they realized they had underpriced it. So actually, for example, back in 2008, John Hancock was one of the companies that had to raise their rates on existing customers, existing clients, by 13 to 18%, which is really kind of unheard of in the industry. Most companies do not raise on existing policies. And that's just how bad it had gotten, because so many people were using this coverage and for a long time that they realized, oh, we need to charge more for this. And so they started raising rates on existing clients. And then in 2010, the company needed to raise rates again by around roughly 40% on those existing clients. And it's not easy for a company to raise rates on existing accounts. They can't just go ahead and decide, I'm going to raise rates. I'm going to raise all your rates. They have to actually ask state regulators for permission to raise those rates. So they had to go out there, ask for permission, and then they had to raise it not only once, but twice. And so back at that time, other companies were doing the same thing. A lot of companies actually were having to raise their rates. And so since then, they have repriced these products for new clients, and they don't expect to have to raise rates again. So now newer policies are costing more than what they used to, and they took away some things like lifetime benefits. Although, again, I do know of at least one company that has this style of policy that offers lifetime benefits. So the industry is saying, well, we don't expect to have to raise rates like that again on existing accounts. However, when you're completing an application, there actually is a notification that we must have you initial that says, well, I understand that my rates could raise again. The company may have to reprice everything, and they may raise on me on this contract. So although your price is essentially fixed once you acquire a contract, and they don't mean to raise it, they don't intend to, and that's not very common, it is a slight possibility. And if that were to happen, you would be given options, or else you could just call and make one of these options. You could ask them to change your benefits, lower the benefit, drop an inflation rider, or something like that to get your price to be the same so it doesn't have to increase. But then you will have less benefits than what you started with. So another feature that comes with these contracts is the inflation protection option. I have seen it with every contract. You're able so far to select an inflation percentage. So you might select 3%, 4%, 5%, and you can have this inflation rider last for your lifetime or select a period like 20 years. And I don't know if all companies allow different time periods like that. They might only offer one or the other, or they might offer both options or different options. But I've seen a lot lifetime options, or you can have inflation for up to 20 years. And then wherever your benefit is at that time, it would just stop growing, because this inflation rider takes effect as soon as you begin your policy. You'll have a 3%, for example, compounding inflation rate on your benefit, so that next year it will be 3% higher and 3% the following year, and so on. So I actually feel that this inflation rider is pretty important to have on your contract, because even if you were to acquire the maximum allowable daily benefit or monthly benefit right now, it's already too low for today's need. So they won't even allow you to lock in high enough benefit right now to cover all of that need in today's costs. I mean, it may be sufficient, just depends on what your needs are, of course. But if you have a lot of need, it may not cover all of that, even if you have the highest today. So I think it's good to have whatever you're able to afford now to throw on one of those inflation riders so that your benefit will grow by the time you're in your 80s or 90s even, so that it will be much higher at that time when you'll need it. Which, of course, with overall inflation in the nation, it will likely still be a lot less than what you actually will need, but it will certainly come in handy. Elimination period, that is another option that you will have to select when purchasing one of these policies. It's another basic term in the industry for these policies. The most common elimination period selected is 90 days. Although some contracts will allow you to select 30 days or maybe 180 or 365 days. What this means, it just means how long you have to wait before you will start to receive your benefit. How long do I have to be unable to perform 2 out of the 6 activities of daily living before my benefit will kick in? There is another option that sometimes people ask about called return of premium. A lot of companies do have this. And what that means is that if you end up not using your policy, say at your death, you would be able to receive back as a death benefit for your beneficiaries the premiums that you've paid. And so that might look good for some people, and really it's up to you. But choosing the return of premium rider will increase your overall cost for the insurance. And so you might end up paying, say, up to $100,000 or more for the contract than you would have otherwise, maybe almost twice the price of the coverage, just so that you could receive that back as a death benefit when you pass away if you end up not using the coverage. So if you're concerned about that or wanting to add return of premium, or that sounds like something you would want, you may consider then just looking into a long-term care life insurance hybrid policy. My favorite style of that is a whole life hybrid policy, but they do also have a universal life hybrids as well. But that just is a policy that, again, the purpose is for long-term care. So it's not going to build this amazing cash value, and it's not really intended to be used. So you don't really want to have to go to your long-term care whole life policy or hybrid policy to be doing infinite banking or borrowing against those funds. That is not the place to do it. That is for your long-term care. But if you're looking for a death benefit at the time of death, if you did not use your long-term care, or you did not use all of your long-term care, then that is a style of policy that you would probably prefer. And with those policies, another benefit is that that premium is guaranteed. Just like with any whole life policy, your premium is guaranteed never to go up. So with the other style, the more pure long-term care style, they can increase your rates even though they don't expect to, and it isn't very easy. They do have to ask state regulators for that, the ability to do that. But with a whole life hybrid policy, they were not going to raise it. It's going to be fixed at that price and guaranteed. So the life insurance hybrid long-term care policies do come with a little bit different structure and how you can build the riders in and the different features that you want. But a lot of the things that I mentioned are also available in that style of policy. And this is essentially the main things you'll be thinking about when you're looking for a long-term care policy. Certainly there's other information to describe and explain through when you are acquiring one of those, but that is more of the basic information and things that you'll be selecting. Another option aside from the long-term care pure policy and the long-term care whole life hybrid policy would be like a fixed annuity. There is a company that I know of, and maybe more than one, that offers a fixed annuity, which kind of functions like a CD, has a certain surrender time period. So you're going to have it locked in for probably at least 5 years or so. But these contracts would offer you 2 or 3 times the amount that you put into it. So let's say you have $50,000 and you want to put it into an annuity like this, then depending on what you qualify for, which is up to the company, they're going to underwrite you. And then based on what underwriting comes back with, you can qualify for 2 times or 3 times that amount that you just put into the contract. So $100,000 or $150,000 that would pay out for a long-term care need if you were able to trigger that policy, which again takes 2 activities out of the 6 of daily living for you to be unable to do to trigger that policy. And in the meantime, your cash is earning just a fixed rate, whatever that is. And usually those fixed rates can change each year, but you have that money into that contract for a time period. It's a multiplier of 2 to 3 times, depending on how underwriting goes for you, that you could receive for a long-term care need. And then at the end of that surrender period, if you didn't want to have that contract anymore, you could move your funds somewhere else, and it would just, you wouldn't have that protection anymore though. So aside from these options that I mentioned today, of course, there is the whole life contracts that come with the rider, the chronic rider or accelerated death benefit riders, which would accelerate that death benefit to allow you to pay for those costs if you were to have a long-term care need. And those riders can pay out in lump sums or maybe in periodic payments throughout the year. It just depends on the company and the wording of their contract. Well, that's all I have for you today and all I have for you on the topic of long-term care, at least for now. I hope that this was helpful to you in some way for you or maybe a loved one, your parents, maybe some information that they could use. If this is something you're more interested in learning about or how it would work out with an infinite banking style policy or how we could start with that and build on it going from there, and you'd like to work with me, please reach out. I'd be happy to connect with you. you can reach me at Valerie@alphaomegawealth.com. Well, thank you so much for listening. As always, I hope you have a wonderful week. Take care.
This is thepodcastfactory.com.